Okay, my next question has to do with, despite the expansion that we're recording in the financial markets in terms of banks coming together or acquiring one another, as the case may be, there's still the challenge of having to translate it to growth in its tangible form, because we're still seeing the level of poverty still high in the economy. The lending to the real sector, well, that may have improved, but the interest rate is still on the high side, despite the fact that the banks or a bank can afford to lend single-handedly, to lend out 10 billion naira or $10 billion, as the case may be. What's your take about that?
Well, you have to look at it from the different perspective. Yeah, basically, you're now looking at what are the macroeconomic factors that have been that create the expansion, particularly to the retail sector,
and that's
or the small and medium scale enterprises.
And the impact on the economy,
yes,
on individual businesses.
You see, if you look at it, who are the beneficiaries of the bank's loans? The big commercial and corporate entities that have the financial muscles to pay, and they have the financial muscles to weather some of the inclement infrastructural deficiencies we have in the country. And what I mean by this is, if you lend to a multinational like Shell, if they have to do an oil prospecting in a particular location, they have the capacity to tar the road from wherever they are, from wherever the road ends to wherever their onshore asset is. The small-scale entrepreneurs do not have the financial muscles, and you cannot lend to them to build infrastructure, which the government should have built. So some of the challenges we have, which what we tend to overlook, is that the cost of doing business in Nigeria is so high that the small-scale entrepreneurs are not cost-efficient and cannot compete with organizations that are producing the same products outside this country and being imported into the country. And because they are cost inefficient, then if you lend to them, their operating costs will swallow up the loan you have lent to them. What I mean is that a lot of them cannot operate profitably if exposed to competition from operators of the same producers of the same products outside the country. And that makes lending to them more risky. In other countries where you have efficient infrastructure base, then it's easier when you lend to them for those institutions to generate enough revenue to pay off their loans. So you have a major challenge, which is the cost of doing business in Nigeria, particularly which is more adverse to the small and medium-scale enterprises. Then the other issue is the issue of what is the cost of funds. There are two measures of cost of funds. You have what we call the rate cost of fund, which is basically what is the aggregate cost, the average cost that you are paying to those who are giving you money, the interest rate you are paying to them on call deposits, on current accounts, on fixed deposits, what's the average that it comes to. Then you also have the all-in weighted average cost of fund, what we call all-in WACC. The all-in weighted average cost of fund will also divide the total operating expense of the company as part of the cost of the funds you are lending out. So when you do that, it becomes very high, because one, you have the cost of sterilizing funds in terms of the high level of cash reserve the central bank has imposed in order to manage the liquidity. Because when you take money from, for instance, from commercial lenders at, let's assume 10%, and 15% of that is sterilized, you are left with 85% to lend. Of that 85%, you have to keep 40% or 30% in liquid assets. Those liquid assets earn you close to nothing. So by the time you are now, when you keep another 30% in liquid assets, you are now left with 55% to lend. And you have to recover the cost of the entire 100% on that 55% you are lending. So when you have a high rate of cash reserve ratio and high rate of liquidity ratio, what it does is that it reduces the loanable funds available to the banks, and the banks have to use that limited loanable fund, the pricing of that limited loanable fund, to recover the entire overall cost of the entire deposit bill they have. So you have to look at it from that angle. When the government drives a policy of reducing the liquidity of the banks, the impact is that the rate of interest rate will go up.
And the lending,
the lending rate will go up.
The lending could drop as well, even if the rates go
lending
up.
The volume, lendable funds will reduce,
the lend
and then
will drop,
and
the rates will increase.
will go up.
Okay, I know that this is a very interesting topic, but let's get really further into the issue of acquisition here. We've seen activities from other climes, and Nigeria is taking advantage of other countries, the opportunities in the banking and financial sector, and also some other companies or in other countries coming into Nigeria to also take advantage of what the opportunities they can get here. And one of them, of course, one of the most recent is that of the Heritage Bank being announced as preferred buyer for Enterprise Bank. We're also expecting the Asset Management Corporation of Nigeria to also announce the buyer for Main Street Bank. I don't know if that has been announced, but we're expecting that. So what does all of this say? Although, well, look at the fact that these breach banks, they were actually breach banks, they were bailed out. They couldn't recapitalize despite the effort by the central bank and even AMCOM to bail them out. What does that spell for the financial markets, especially the banks?
Well, we have to look at the two of them in different perspectives. One, what is motivating the Heritage Bank or whoever will be the acquirer of Main Street and Keystone to buy them, and what is the motivating factor, what's the reason behind the sale of Enterprise Bank, Main Street and Keystone. Like you rightly said, these other three banks I mentioned last are breach banks, acquired by AMCON as a result of the insolvency of those banks, and for which the federal government, in effect, they were nationalized banks. And right now, AMCON wants to exit its holding from those banks. And a couple of banks have expressed interest. So what will be the motivation for a bank to acquire any of these banks? For Heritage Banks, interestingly, and I think one of them will be here, they are clearly obvious reasons why they have to acquire the Enterprise Bank. One of which is that Heritage Bank, as it is now, is a regional bank. They need to acquire national license. So acquiring Enterprise Bank will automatically bestow on them a national license, which will allow them to operate nationwide, unlike the original banking license they have. But beyond that, it will also help them achieve economies of scale. Heritage is still a small bank relative to the industry. Okay, by acquiring a bank that has maybe close to 2,000 branches, it automatically means that Heritage Bank will become a middle tier player in the market, unlike today it's a fringe player in the market. So that will automatically catapult it from one of the last to a middle player in the market. So it will achieve economies of scale. The benefit of economies of scale is that the cost of service will drop, and then its margins will widen, and therefore it will be able to generate enough return to its shareholders.
The cost of service will drop.
Yes.
That could be questionable because of what has been happening when a bank takes over another bank. Sometimes they lay off the staff of the banks, employ new people, and you see protests everywhere. Bank workers protesting that they've been laid off the work, and some are even turned to be casual workers in the banking sector. So there are a lot of issues that are tied to the issue of acquisition and mergers in the financial market as a whole.
Well, I'll come back to that. Well, what I mean by their cost of doing business and their cost of service will drop is this: they will begin to enjoy the economies of scale. If it takes them, for instance, if it takes them 1 naira to produce a service of 1 naira 20 kobo, that cost will drop because it has a larger base to share. There's what we call operating cost. I have the fixed cost. The fixed cost is shared as it reduces on a per unit basis as the volume of service you render increases. So the fixed cost element does not necessarily increase as your economic activity increases. And that's why your average service cost will drop when you have a larger base.
All right.
But back to what your question, which is, we always have issues when there's a consolidation. Of course, the issues are the human capital issues, integration of people from different, you have the cultural conflict, people who have been groomed to practice a particular kind of corporate culture being integrated into another culture. You have, like I said, you have the human capital issues. Okay, you have the post-major acquisitions of discovering sometimes assets that have been recognized as performing assets. But let's look at the two issues you mentioned, the issue of culture and the issue of integration of human capital. You see, when you have a change, when you're in a change environment, two things will happen. There are duplications of roles that have to be harmonized. Duplication of roles that today, Heritage has a treasurer, Enterprise Bank has a treasurer, eventually you have one treasurer, which also will lead to the reduction in cost, overhead cost. Today they have two managing directors. Probably they have executive directors on this side and executive directors on this side. They would select, and probably they may broaden their management team, but they're not going to have integration that will allow for all the executive directors to come on board.
All right.
They're not going to have two MDs.